Insightful Value here with an eye-opening take on why NH Foods stock is depressed and whether it might be a hidden value play. This review is for informational and educational purposes only, not financial advice. Remember to subscribe to the channel and hit like if this resonates. Today is July 25th, 2025. NH Foods, traded as Nipponim on the Tokyo Stock Exchange, is a leading Japanese packaged foods and meat processor serving domestic and global markets. From a value analysis viewpoint, the company faces a downbeat share price but holds strong fundamentals. In fiscal year ending March 2025, NH Foods generated revenue of 1.37 trillion yen, up about 5% from the previous year, though net income declined roughly 5% to 26.6 billion yen. Profit margins slipped to around 1.9% from 2.1% due to rising input costs and supply pressures. Operating cash flow remained solid and free cash flow came in at 30.3 billion yen. The company carried total debt of 224 billion yen versus equity of 524 billion yen, with a price-to-earnings ratio around 19 and price-to-book close to 1. Book value per share rose to 5,300 yen, and EPS was about 263 yen per share. NH Foods announced a share buyback equivalent to 6% of outstanding shares in May 2025. Dividend development has been consistent. NH Foods has increased its annual payout every year for 6 years straight, with the most recent dividend at 0.79 euros, or roughly 135 yen per share, yielding about 2.7%. The payout ratio stands at roughly 50% of net earnings and 32% of free cash flow, indicating strong cash coverage and dividend safety. So why is the stock languishing? Investors are cautious about limited growth potential in Japan's mature food market, compressed margins from rising raw materials, including feed and logistics, and lingering negative sentiment from recent profit downticks. While analysts forecast modest earnings growth over the next 3 years, roughly 1.4% revenue growth and steady margin recovery, the higher PE ratio versus peers reflects skepticism that those projections will materialize. Sentiment remains tepid despite improved dividend reliability. Risk factors include input cost volatility, demographic decline in domestic consumption, foreign exchange exposure from exports, and potential agricultural policy shifts. On the positive side, NH Foods benefits from scale in processing, diversified distribution, long relationships with retailers and exporters, and pricing power in staple protein products. Why might now be interesting? If raw material costs stabilize and Japan's export demand remains resilient, modest earnings recovery and continued dividend growth could re-rate valuation. But why not now? If margins remain under pressure or growth stays flat, sentiment may stay subdued and valuation unchanged. The chances of a price rebound hinge on margin improvement, better than expected earnings next year, and recovery in investor confidence. In summary, NH Foods is not failing. It's a large, cash-generative protein processor with stable dividends and modest growth. Its stock reflects caution more than collapse. For value-focused investors watching income plus stability in mature markets, it may deserve a spot on your radar, just with realistic expectations. For deeper insights on NH Foods and other underappreciated companies, head to InsightfulValue.com, where we turn complex data into clear, actionable takeaways without the jargon. Thanks for watching. Please subscribe for more in-depth value analysis and visit InsightfulValue.com for extra coverage.